So greetings from our nation's capital, where today we're going to talk about the acquisition of a $1.9 billion stake in Southwest Airlines by Elliott Investment Management. And if you're going to talk about the airline business in DC, I could really only think of two places to use as a backdrop. First would be obviously the Department of Justice, but the friendlier, less partisan one would be here in front of the National Air and Space Museum. So that's what we've chosen. We're not going to talk about leadership here. We're not going to talk about culture. We're not going to talk about business strategy. What we're going to do is focus quickly on intelligence that we don't think exists otherwise in the marketplace. And even though what we're going to talk about is based on DOT data that's publicly available, we believe that Signal Aviation Consulting is alone in the consulting world anyway at understanding how to break down the costs and revenues that DOT provides for domestic itineraries into an allocation of costs and revenues that are accurate in reflecting largely how airlines look at those markets, not only based on fare but also ancillary revenues and specific cost, and importantly connecting traffic and the allocation of those costs and revenues in the way that airlines do. And what we see when we look at Southwest, obviously everybody knows that they have lagged United, American, and Delta significantly in the post-COVID era. What's less well known really is that their performance in 2022 versus 2023, pretty much across the board, we saw a degradation of about 10 percentage points in what we call domestic network operating margin. That is the extent to which their revenues cover or in a lot of cases don't cover their cost. Southwest on average, whatever it was doing in a market or system-wide in 2022, its margin dropped 10 points year over year. What's different is that a lot of other airlines all the other airlines really faced the same cost environment, largely the same jet fuel prices, other than the extent to which Southwest is a little more hedged than others. And the fact that they've all negotiated huge increases in their pilot contract. So those costs are all coming down the pike and to some extent starting to be reflected. But what's different is if you look, for instance, at Delta Airlines, Delta at its most important hub, Atlanta, obviously, not only did it make money in 2022 at Atlanta, it made more money on a margin basis in 2023, and with one minor exception that I won't mention here, every market it operated year-round in 2023 made money. By extension, or by contrast really, Southwest, if you look at any of its important markets, Los Angeles, Phoenix, Las Vegas, Denver, Houston, Dallas, Atlanta, Orlando, Midway, Baltimore, Washington, every one of those markets has two things in common with all the others. They were unprofitable in 2023 and lost ground on average about 8 to 10 percentage points. So while Delta improved, for instance, its profit margin in Atlanta by 2 percentage points in a very similar cost environment absent jet fuel hedging, Southwest lost 8 to 10 points on average. So Southwest's model currently, for whatever reason, and we're sticking to the facts here, we're not talking about root causes or what their solution should be, but for whatever reason, Southwest currently across its network in every market we looked at is losing substantial money, more than it lost in 2022. And that has huge implications for any solution that Elliott Capital Management or anybody else should want to apply in turning Southwest around. Ultimately, whatever they do, whether it's Southwest current management, new management, or some combination, ultimately there's two things. The company needs first to identify, probably through what we call a double diamond process. We didn't invent it, by the way, somebody else did, but we use it. First, go through a divergent and then a convergent exercise to identify all the possible root causes of Southwest problems. A lot of people are going to jump on things like no assigned seats. We're not convinced that that's the problem, but going through a exhaustive exercise on what all the possible root causes are, and then converging those down to a small set of 1 to 3 real root causes, and then taking through a second diamond and figuring out what are all the possible solutions to those root causes, and then narrowing those down to 1 to 3 key solutions and then executing those with excellence. Whatever the solution to Southwest's financial and stock market lagging performance is, will involve something like that, and dealing with facts like the fact that according to our analysis, basically right now, Southwest has nowhere to run and nowhere to hide in terms of market profitability, so wholesale improvement is necessary. This is hard for us to say because all three of our principals at Signal are Southwest alumni. So we don't say this with any malice or anything other than just as clear-eyed a view as we can have to the reality of Southwest performance based on the data that are available, analyzed the way that, so far as we know, only we are analyzing it, and coming up with these hard conclusions. And it'll be interesting to see what happens in the weeks ahead. Love to know what you think. Anytime you think we're right, think we're wrong, it doesn't matter, we'd like to hear it. Thanks for tuning in.